Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
G'day, welcome to the Australian Property Podcast, our weekly 2 cents segment. I'm Pete Wargent from Alan Wargent Property Buyers, and I'm here with Chris Bates from the Flint Group. Bates, I haven't spoken to you and it feels like ages. How's things?
Well, it's probably only a week, Pete, but it's always a long week between you and I, and always look forward to these chats. I'm running off a high. It's Thursday morning here, and obviously England are through to the final, which you'd be pretty happy about as well. So, still buzzing from that, Pete. What have you been up to?
Yeah, it was only an hour ago as we record or so, wasn't it? I was all getting stressed out and all set for it to go to extra time and penalties, and then the inevitable elimination and recriminations, and then suddenly in the 90th minute, a goal for England, and the St George's Cross will stay on the front garden for another week. So the kids are thrilled. So what else is new? So I've been camping this week. I think you were a couple of weeks ago. So I'm sore. I'm tired. It was Cub Scouts camp, and obviously it was good fun, but gosh, it takes it out of you at my age. But what else is? We've just been busy at work and just focusing on delivering our 5-star service for our property buying clients as always. And that's about it, my end. And just recovering from the football.
Yeah, we had a bit of a weekend away, my wife and I, last weekend. Left the kids for the second time ever. So that was nice to kind of finally feel we might be coming out the other side and getting our life back. But we didn't talk about the kids the first night, but all day Sunday before picking them up, we just talked about them. So obviously we were missing them. So obviously lots going on at work as well. We are interesting time, July, particularly after, around school holidays. We do notice that, in the next couple of weeks, we do find a lot more inquiry. If people really die off in June, it's usually a bit of a slower month for us. But, as this time of year, people started going, well, I've been putting it off. Maybe I really want to try to buy in spring this year. And we've absolutely seen that in the last week, inquiry start to increase. It's interesting. I mean, it kind of leads into our first story, Pete. So why don't we get cracking into that?
Yeah, okay. Well, the 3 stories we're going to cover this week. So firstly, we're going to run through the lending finance figures, but also just to talk a bit about what's actually happening in the lending market, because obviously this is what Chris does day in, day out. So just get some insights into what people are doing, what they're not doing. Second story, SQM research, listings plunge in a winter lull. So that kind of echoes what you were saying. Stock levels still very tight, really, when you look across the market. And then thirdly, just going to explore a couple of Chris's insights from LinkedIn. So if you're not a follower of Chris on LinkedIn, I've lost count. You must have 30,000 followers over there these days, and a big thought leader in this space. So there was a couple of interesting insights, particularly a window of opportunity for upgraders, but also the few thoughts on the rental crisis and how the longer that goes on, I guess the greater the incentive for people to want to be an owner or buy. So let's start with the lending finance figures. So I guess the ABS puts these figures out monthly, and I guess we had such strong figures for a few months in a row. We were definitely due for a pullback, but overall, I mean, we're in a solid uptrend, I guess. First home buyer numbers are solid. We know that some investors are selling, but actually lending to new investors is in a very solid uptrend, about 30% higher over the year. The average loan size hit a new high. So generally, lending is pretty strong. But the one thing that it's not strong for is for new homes and for construction. That's really just way below the 20-year average. So what are you seeing, Chris? Obviously, people come to you guys all the time. What kind of trends are you seeing there?
Yeah, so it's interesting. I mean, we didn't talk about it this week, but CoreLogic have done their monthly housing pack. I mean, anyone listening to this should absolutely download that every month. It's as soon as it hits my inbox, I click it. Not many things besides your blog, Pete, I read straight away. But it's interesting. You can see on that pack is that it's the bottom 25% of the market that's actually growing the fastest and has got the most pressure under it. And that's due to how tight borrowing capacities are, not just for first-home buyers, for first-time investors, or it's not many big portfolio investors buying, to be honest. They're usually well capped out and have bought earlier. That's just naturally what they do. And when borrowing capacity goes up, maybe their income goes up and capacity goes up, they'll buy more, but they're probably all tapped out. And so there is a lot of first-time investors and a lot of first-time investors who probably be home buyers, but they just can't see a way based on their incomes and their savings to get somewhere they'd like to live in long-term. Maybe they're living in Sydney, Melbourne, Brisbane, and to enter into the housing market which they want to live in, it's just not possible. Maybe they can't even get into the good apartment market, so they're buying investment properties. So they go down as investors, but really they're first-time buyers. And so I do think there's this real push at the bottom end, and I think the rental crisis is playing into that. I don't think there's many in the upgrader space really transacting. You can see that just because the housing markets in our capital cities are really tight, and that's typically where the upgrader market plays rather than the apartment market. But yeah, the numbers do look pretty impressive. The total amount of loans going through and average loans are going up, but it's really driven by that low end. And I think what's at the top end and the top 25% of properties have really got a handbrake on them, but it won't be forever until that handbrake is released. And it could be released in multiple ways. It could be released in rate cuts, APRA stepping in, bank innovation, more wage growth. And all of a sudden, that part of the market goes, hang on a sec, I thought I could borrow X. Now I can borrow Y. And there'll be that FOMO in the market and it'll really push on. So, yeah, it doesn't surprise me. AFG came out this week with their AFG index. That's a great report. If anyone else wants to have some other reading, I always read that, even when I wasn't part of AFG. And, I would say that's my thoughts on lending. There's definitely appetite there for first home buyers, but it is a have and have nots going on right now. There's not much loans going in at over 80%, anywhere near like longer term. And that shows that people are getting big deposits down from generations above them, but not everyone's that fortunate.
Yes, you're right. In the chart back, there was a couple of things that stood out there. Obviously, when you look at lending mortgage rates, they're much, much higher than they have been. Now, obviously, there's different products out there, but the average mortgage rate's clearly increased. A couple of things that stood out there. New interest-only lending is back up to about 20% of loans. So I guess that's made a bit of a comeback. But overall, it just seems like the lending settings are very tight. There's not much risky lending going on. There's very little lending at over 6 times income. And obviously with the lending assessment buffers in place, that kind of takes care of that anyway. So, I think overall, it does seem like the bottom end of the market is where the growth is happening. And I think, there's a few things. The cost of construction's gone up a lot. So the supply is not really keeping up. It's really lagging the demand there. I think, a lot of people have been pushed down into those price points because they can't borrow as much. And the lending or the rental crisis, I think there's some suggestion from CoreLogic's chart back there. So rents were up 0.4%. In the month and 8.2% over the year. So still going up, but just not quite as much as previously was the case. So those are the lowest numbers since November, but it's still, there's not really much respite there. I think on the day we're recording, I think we're getting the latest figures for arrivals and departures, and they generally show that in the middle of the year, there's more people actually leaving the country than coming in. But then as the year goes on, the summer months, the students are back, and that goes into reverse. So I don't know if this is a false dawn for the rental market. It's still tight, but I think, potentially when people start coming back into the country, we could get a second wave here. We might not be quite out of the woods yet. And obviously that encourages first-time buyers to try and get a toehold in the market.
Yeah, I mean, I just did a quick type into Google there, ASX tracker for rate tracker. Not that it's gospel, but I do like the percentage likelihood where rates are going to go. And I mean, just 2 weeks ago, it was a 40% chance they reckon that rates were going to go to 4.6. Today, it's 22%, right? And so it just shows how much volatility there is on the expectations of rate. And as that potentially has decreased, that gives people more confidence that rates aren't going to go up too much. And you can start to, that will start to build confidence. And I think it's a time where confidence matters. It's if buyers are coming into the market now, getting ready for spring, because they think rates aren't going to go up that much more, and there are going to be rate cuts in 2025. That's a good sign of momentum and sentiment coming into this. Now, that could easily flip again, but the freak out of a couple of weeks ago is slowly dissipating. You're absolutely no new construction loans. That we've already spoke about this on podcasts so many times, how the difficulties for developers to make it work at the first home buyer level, even the investor level. And yeah, they can do it for the cashed up upgrader or the cashed up downsizer, but not really at that, mass market product. And we're seeing very few clients looking to do renovations. I mean, even myself are in this camp. It just doesn't make sense, A, because of the cost, and B, because if whatever we do spend, we're going to have to pay 6 or 7% interest rates on that money. And that's a lot of money to be paying in extra interest when you're already struggling cash flow wise. And so I think that's really slowed down that renovator. And there is obviously the people who are in retirement looking to, build their forever homes. But, obviously at this situation here, they might be going, well, I just want to leave that money in my super fund. I don't want to leave that money in a property. And I think I'm going to get better returns that. And so people become a little bit more conservative when the rates of return they're getting on other investments. And so I think that's pretty tough times going forward, unless you're doing something really premium building where money's not a challenge and people are really cashed up. You wouldn't want to be a developer right now. We're seeing very few clients look for renovations.
Yeah, I think it's an interesting point you made there on interest rates. So what has changed over the past 2 or 3 weeks? There's a couple of things. Firstly, rents. I think it's generally now seems to be the case that we're past the peak for rental price inflation. So that's one thing. I think the biggest one potentially in Australia was the NAB survey. So I guess that's the nearest we've got to a real-time indicator of what's happening in the economy. Business conditions are continuing to deteriorate. But I think the big thing in June was that labour costs, the percentage change at the quarterly rate dropped from 2.3 to 1.8%. Purchase costs were down from 1.7 to 1.3. Final products prices down from 1.1 to 1.7. So I guess that all of that just points to ongoing disinflation. And a good friend of yours from previous shows, Shane Oliver from AMP, has this kind of inflation pipeline indicator where he looks at what's coming. And it does look as though disinflation is pretty well entrenched. Also, I think we've had pretty soft numbers from the US. Looks like New Zealand will be cutting interest rates from August. UK, Eurozone. So the global narrative is shifting. I think there's one hurdle left for Australia, though, and that is on 31 July, we get the latest quarterly inflation figures. And I think if the core inflation figure is 0.9% or less, then interest rates will just be on hold. If we get a big number, though, if it's 1% or higher, the Reserve Bank could yet be forced into making another hike or maybe more tightening. So look, it will all really come down to that day. So if you're a market sort of watcher or twitcher, that's going to be the biggest release in months, I guess, 31 July. So that's the one thing, I guess, the big hurdle. If the inflation figures aren't too hot come 31 July, I think everything will just be on hold for the rest of the year. But if we get an outlier, a big number, that could spook the Reserve Bank into making another hike potentially.
Yeah, I just sort of worry, it's kind of called the car crash analysis, right? Where someone potentially overcompensates. It reminds me of my boy last night on his little, what we call little bike without pedals. It's one of those, I don't even know the name of them, right? Where you just, your legs are your pedal, you walk with them. Anyway, he sort of overcompensated. He's coming down the hill. He went left, he went right, and then bang, he went over. And I was like, oh, my God, Tommy. But, I mean, I think that's what's going to happen with the economy here, right? Like they potentially going to over-tighten. They're absolutely going to kill inflation. And then when they're going to go, hang on a sec, our unemployment's going up. We're really looking soft over the next few years for growth. Let's just go all in again. And so you're going to see some significant rate cuts. It's almost like when in 2022, oh, shivers, we've let the inflation cat out of the bag. Let's have to increase our rates from 0.5 to over 4% in a couple of years. And so I do think you just got to be conscious of that. Yeah, in the short term, we've got this higher rates. It's uncomfortable. What's the right setting? But we're close, right? We're not. And at some point, they're going to go, that's killed inflation as it has around the world, and major cuts are going to be coming. And that's not the time you want to be buying. So if you're sitting on your hands and you can transact, you don't want to transact in that market. You prefer to transact in a market like it is today. And so be careful what you wish for sometimes.
I think the warning signs are there. New Zealand is pretty much the Reserve Bank has sent a wrecking ball through the economy there, and interest rate cuts are on the way. I think the canary in the coal mine could be Canada, because that's a country like Australia where they've run extremely high levels of immigration, and jobs growth just hasn't been able to keep up. And then 1 minute they've got low unemployment, now 6.4%. And I don't think Australia will be as extreme. But if you look at the decline in job advertisements, we're still running big immigration numbers. Well, we could easily head towards 5% unemployment. And then as supply chains recover, goods prices fall, retailers start discounting, well, we could actually overshoot in terms of the monetary tightening. So, yeah, we'll have to see where things land on 31 July. There'll be a lot of nerves on that day, I think, for people who've got big mortgages and over leveraged. But I think, look, most market forecasters think we should be on the right side of 0.9%. So we'll see what happens. So let's look at this second story for the week. Listings plunge in winter lull. So this is Louis Christopher and the team at SQM Research reported total listings fell from 253,000 to 232,000 in June. Large declines across all of the capital cities except for Darwin. I don't think it's unusual, as you said, Chris, for that time of year. I think it's quite typical to see a winter lull. But over the year, Perth, Adelaide and Brisbane in particular have experienced very large declines in listings. And of course, prices have increased at a fast clip in those cities. And new listings in June were down 13%. I think a point you made maybe a couple of weeks ago, if you go back to, let's say, 2011, even though the population was about 5 million less or fewer back then, we had listings of 375,000. So it gives you an example of just how tight the market is at 232,000 listings. There's just not that much stock on the market. So, yeah, I think it will begin to pick up again as we head into the spring selling season. But I think, as you said, buyers are going to be somewhat disappointed if they're expecting a lot of choice.
Yeah, absolutely. And the thing that gives buyers the most urgency is when they can't find something to buy. That really is that anxiety, that constant pressing refresh. And I think what you'll find is when you look at the SQM data, we had a conversation with Louis Christopher on the elephant just a few weeks ago, and the properties that don't sell within the first 30 days, it's, that's, potentially because the vendor wants too much money or it's not a great property, right? And so that's going through. Okay, that's okay. So if you're not, you're selling one of those properties that isn't a great asset, you probably still find it a little bit patchy. And there's a lot of vendors on the market that want too much money, right? They can't upgrade unless they get a certain price. And so they've definitely listed the property, but they won't transact. And I think that's what we're finding a little bit in the upgrader segment, which is our third story. And but yeah, I think ultimately a lot of that stuff is clearing out. And that's a pretty strong June month, if I'm honest. If you look at coming into this winter, that a lot of the stuff's getting cleared out, and that's usually the stuff that's not that great. I look at it very similar to the auction clearance rate. When I don't get too obsessed on the 72 versus 70, but I like to see where the trend's going. And it's really, I see that as the desperation meter. When it starts getting really low, it shows that buyers are really picky, and they're only going to compete on a certain number of properties. As it goes higher, obviously that means buyers are willing to buy anything because of that FOMO's in the market, and it's been holding at a pretty sustainable 70+%. Which means that anything that's decent is getting sold. It's not just only the AAA grade stuff. So, but you can see in places like Adelaide, 15% drop in monthly listings, 25-30% less than last year in Perth as well. And that's huge. And I think, Sydney's are up on last year, but last year was a pretty average year and listings were pretty low compared to all-time long-term standards, particularly in the housing markets in our capital cities in Brisbane, and Sydney. And so, listings are there, but that's not in the housing market, is in the apart market where a lot of investors are selling. And that's great news for first home buyers, but it's not great if you want to sort of transact in the housing market.
That's an interesting point, actually, because SQM, they have asking price, an asking price index they release every month. Asking prices up 0.4% for houses and 0.7% for units in June. Capital City asking prices overall up 8.9% over the year. I think, look, unit prices in cities like Brisbane and Perth and Adelaide, they've really teed off. I think at the lowest end of the market, there's just nothing getting built. I think it's very difficult for developers to get projects across the line. I saw this week a bit of debate sparked by an article in the Fin Review about the latest union wages increase for New South Wales. It's going to add 10% to the cost of a new apartment. That sparked a lot of debate because obviously the Fin Review's on the sort of business side of that equation, and the unions might have a different view. But I think just in general, if you look at the building approvals for units for Melbourne, for Brisbane, for Sydney, are very, very low. And it does sort of speak to a likely undersupply over the next few years, at least in the total amount of stock. And I think, so some of the cities have had a really strong time. But if you look at Melbourne and Sydney, I mean, unit prices haven't really done much for 6 or 7 years, I guess. So I think at the very bottom of the market, there's probably some sort of pressure there, first home buyers, first time investors, that kind of thing. And it's sort of being reflected in the SQM asking price index, I guess.
Yeah, absolutely. I think that anything that's going to increase the price of new property is not good right now, when absolutely that's one of the ways out of this is to build. But we can't see those numbers add up right now, Pete. So should we go to story number 3?
Yeah, so this is actually, well, I should let you lead the way here because this came straight from your LinkedIn. But I guess what you've summarized on LinkedIn, and obviously you should give Chris a follow over there. There's essentially, as we've talked about, there's a lack of quality stock for sale, quality homes. I think Chris said that he's had some sort of proactive upgraders just getting a bit more active since April time. And there's a potential opportunity there over the remainder of 2024. So I guess like the general feeling, Chris, is with a sort of a lack of quality forever homes on the market, it's been stopping people from making a move. And I think a lot of people have probably been caught out because the market's been much more resilient over the past couple of years than we might have expected.
Yeah, look, it's not going to be all the upgraders there, to be honest. I've think of a number of clients in the last few days that we've done some numbers for, and I'm like, well, yeah, what you're in now versus what you can upgrade into, it's just not much of a big enough jump. And that's where I think a lot of upgraders are stuck. I would say the vast majority of upgraders they look at what they can spend, what they would want to spend, and what they can spend, I guess, once they sell, and that's even using conservative or even sometimes optimistic numbers. There's just not enough in it. They just haven't got enough equity and borrowing capacity to make an upgrade that's worth it. They can only trade into something that's much more suitable to, what they need. And to be honest, we've actually had that a few times. This is what I call right sizing. Someone's in a property, maybe it's worth, 1.5 million, and they go, look, that's just not going to be where we're going to live long term. Maybe it's a really good apartment. We actually need a house. We've got kids that are getting bigger, or we've got family that we need. We're actually going to right size. So we're not going to upgrade in terms of dollar value, but we're just going to get something that's much better to our needs, and we're going to make some compromises. And I'm hitting of a number of clients that have basically dollar for dollar. They're not too far off what they just sold for, and even one's actually spent less than they, currently owned. But there is this cashed up upgrade. Look, this is a real small subset of the market. It's one that's either got a lot of inheritance money or they've saved a lot of money. They're very low geared and they're on a very high income, and they didn't upgrade a few years ago. So they thought about it and they probably needed to, but they didn't in the 2021 boom. And they just stayed in their home. They got on because they had a small mortgage. They've been saving really well over the last few years. Even though rates have gone up, they've been smashing their mortgage down. And so they're in a very high equity position, and they're on a very high income. So when they go into the market right now, they're kind of the unicorn. They've got very good capacity, and they've actually no urgency to buy because they've got a place with a small mortgage, and they can just sit there and watch the market. And I can think of quite a few clients who are in this position. Watching their buyer journeys, I always just like to check in and hear what they're seeing on the ground. And depending on where what market they're entering, usually because these people are in a really cash position, and not many upgraders are in this position because they're going to their maximum capacity and they're borrowing everything they can from family, and then that equals a number, and that's what they can enter the market at. Even if they wanted to spend an extra, 5, 10, 20%, they just can't do it. And so you're seeing this glut of buyers at certain price points. Everyone's tapped out under tight conditions. And then you've got this opportunistic, powerful upgrader who's got a lot more money than everyone else. And to be honest, they can pick the eyes out of the market, right? So they can be there watching. And just usually what we're seeing is that there's a bit more value for money if you've got a bit more money. Now, those sellers, a lot of them are saying, well, they hold on to a price. I'm not selling unless I get a certain price. But just in the last few weeks, we've seen a bit of sellers who are forced to sell. Maybe they're like, I'm just not confident the market's going to come back in a reasonable time frame. Maybe they've got a bit of personal financial issues and they have to sell. And I think that upgrade is getting a lot better value for money. So the gap between the average stuff and the top stuff is actually quite small now versus in the opposite market when there's a real higher capacity, money's flowing, that gap widens and people pay premiums for the better properties. And so if you are in that position, I do think it's a time to be watching the market and waiting for a quality asset and a vendor that's motivated to sell, because you could come back in a couple of years' time and go, oh, we could have bought that at that point for that price. And now that gap's really blown out and you've kind of missed that opportunity. And so we had a couple of clients in the last few weeks up on the northern beaches that have missed out. But when you look at what they were buying, it was, so pretty good buying if you on reflection compared to the last few years.
Definitely is. I think, I guess like just a couple of sort of macro themes to wrap up this week, Chris. I think the first one is, I think the global narrative is shifting now. I was looking at over the sort of past week, and the Bureau of Labor Statistics in the US released the latest jobs figures, and they were superficially okay, but there's lots of downward revisions. Unemployment rate has now gone in the US from 3.5% to 4.1%. Look, there's people who have paid a lot of money to guess this stuff. Will the Fed start cutting rates in September or October? Look, I don't know, but you can see the narrative shifting there. And if you look at, say, Citi, for example, they think 200 basis points of easing by over the next 12 months. So big interest rate cuts in the US. I think New Zealand, Canada, UK, Eurozone, all those countries are going to be easing interest rates over the next year. So as we previously talked about, end of July is the key sort of date for Australia. Have we peaked with inflation? Are there still issues? We don't know. But I do think that narrative is going to shift over the second half of 2024 and through 2025. So that's one. The other thing which came out just over the past week, if you look at lending for new homes, in 2023, 172,000 dwellings were completed, said the Housing Industry Association. The annual demand for housing is above 227,000. So that's 50,000 homes a year shortfall in Australia. And that's just, there's been a small turnaround in lending for the purchase and construction of a new home, but for very little. We're way below the 2-decade average. So I think, I don't know what happens in the next 3 or 4 weeks, but I do think if you're looking out over the next 1, 2, 3 years, the narrative is going to be about interest rates coming down and just this big shortfall of housing in Australia. Those are, I guess, we talk a lot about the weekly news articles, but I think those are just two big themes to think about. Because that's adding to the rental pressures, high dwelling prices, a lot of pressure on the market. But the one thing is a lot of borrowers have been under stress, and potentially that narrative is going to shift over the next 2 or 3 months as we head into the US election time.
Yeah, and I think my other post, which you kindly chose to talk about today, but I mean, the other post around the rental crisis, I can absolutely see that you think about the lower end of the market is that it's still cheaper to rent than it is to buy, right? Because interest rates are really expensive. And when you add in strata costs and things like that, but people are saying, well, I'm going to pay a lot of money in rent. There's this, belief that rent money is dead money. Well, interest is dead money too, unless your property goes up in value as well. But ultimately there's that. My rent's going up. I don't want to move back in with my parents. I'm really going to focus on getting some housing security because I've been kicked out or, I worried about even getting a place. Imagine just being in the queue of 60 people trying to rent an apartment. It's your third apartment you've looked at and you keep missing out like that. And you're going to be homeless in 2 weeks. I've also seen in the housing market, a lot of people are saying, well, I'm not selling because I just don't want to be in that housing market. That to me is riskier than selling right now, and I don't want to be out of the market. And plus, I don't want to sell because I've been surprised how the market goes up, and I don't want to be stuck in the middle. And this rental crisis is absolutely going to start slowly but surely draining our rental supply in our capital cities, because investors won't go there because interest rates are higher, their capacity is really tight, and they're going to flock to investor hotspots, right? Because there's a proliferation of those type of buyers agents in the market right now, all over socials, and promising the benefits of higher yield, and they're also betting on the short-term returns that they have seen in their clients, and everyone's sort of just drinking the Kool-Aid, if I'm honest. And I think what they aren't realizing is that you're actually making a long-term shift to our rental supply. And when the factors that drove prices up reverse, as in interest rates come back down, and people want to get back living in our capital cities, and you'll start saying, well, there's a rental crisis and people will be forced to buy. And so I really see this anxiety around renting long-term is almost evaporating, because people are saying, well, their ability to rent long-term, I've got to get security, and I'm going to do everything I can to get that. And so I think if this drags out the next 2 or 3 years, rates are higher for longer, rental supply is going to get tighter and tighter. More and more investors are going to bail. Rents are going to continue to go up because the rental supply is going to get tighter. And then that's going to build a pressure cooker to buy. It's just going to keep on getting stronger. And it's going to have a long-term shift. 5 or 10 years of a reallocation of our rental supply have real long-term consequences. And I think that's what's going to play out.
Yeah, more people are getting the bank of mum and dad involved for that exact reason. So that's about it for this week then. So look, this goes out Sunday morning. So if my maths is right, it's Sunday evening European time when the European final will be on. So I guess around about the time this goes to air, we'll be seeing England v Spain in the UEFA Euro final. So all of that to look forward to over the weekend. And what plans have you got, Chris?
I think it's pretty normal, birthday parties. I think Ellie's going to a Frozen sing-along. I think I might pass on that one, do the drop and run. But just kids' birthday parties and hanging out with family here. So
I'm pleased to tell you they do outgrow that. I've been through the Frozen phase. I can tell you the whole movie line for line, but thankfully they do outgrow it eventually.
Yeah, that's right. So thanks everyone for listening. Happy Sunday. And I think, Pete, the final's Monday morning, not Sunday morning. So still 24 hours to go if you're listening on Sunday.
Yes, you're right. Australia's ahead, isn't it? Yeah, it's 8 p.m. European time. So yeah, Monday morning for Australia if you're listening and or tuning in to watch that. And as usual, there's all the links in the notes. If you want mortgage broking, there's a link there to get in contact with Chris, property coaching or property buying. Drop us a line. Always happy to help out. So yeah, have a great Sunday, everyone, and speak to you all soon.
Speak to you soon.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.